Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tigre. Our victim of the day is the famous Bruce McLeod of the McLeod mining family of Canada. Many members of the McLeod clan have made a lot of money for a lot of investors, and Bruce has done it before, and now he's CEO of Sabina Gold and Silver, which has one of the highest grade undeveloped gold projects in northern Canada, or in the world really. It's an exceptional project. It's in an exceptionally interesting place to work. So, Bruce, why don't you tell us about the project, what you're doing now, and then we'll get into the obvious questions that our viewers will have.
Again, in southwestern Nunavut, this is a very high-grade series of deposits. It's within an 80-kilometer-long district that we own 100% of the potential gold-bearing rock, the Banded Iron Formation. We have focused on an 8-kilometer portion of that trend and developed a little over 5.2 million ounces in that portion, in measured, indicated, inferred at over 6 grams. And another portion of the property that we really haven't set foot on from a drill perspective in probably 7 years now, 6 years, is what we call a George property, same geologic setting, and another 2 million ounces in indicated, inferred at over 6 grams.
And these are open pit ounces?
These are a combination of open pit and underground. What we've done on the Goose portion, or that portion that 8-kilometer trend we've been focusing on, is we've developed a feasibility over that. It is a 3,000 ton a day plant that's predominantly open pit. We're 72% open pit and 28% underground. And that study was done in late 2015, and it used $1,150 US gold with an 80-cent dollar and showed a 24.2% after-tax rate of return and a $420 million capital cost. Subsequent to that is obviously the permitting side.
Right.
And
sorry. Before we go,
sure.
I was actually going to give you more runway here, but we got into this. But you said six grams high grade, and somebody might say, well, if that was underground, that wouldn't be high grade. Do you have a breakdown of open pit average grade versus underground average grade?
They're very similar. Some of the pits you see some higher grades earlier, but particularly in the underground, it's not uncommon to see 10, 12, 14 gram blocks within the underground. The overall grade is again in the pits and underground are both just over 6 grams. I think if we look at some other standalone underground operations, particularly in the north, with bulk mineable type ore bodies, is you can make them work at 6 grams. But the big issue is getting over that initial capital and infrastructure hurdle. And you can't compare the costs of open pit versus underground, even in the Arctic.
Sure.
Much cheaper from surface.
So if you have an open pit that pays for the mine, and you're there already anyway, you've got a plant already built and paid for, then the underground becomes easier.
Well, it's with that capital now behind you and just your sustaining capital of underground development, it's more than economic. But if it were just a standalone underground mine, I think it would probably your capital cost would be significantly higher because of all the underground development required, and your sustaining cost again much higher than. These are single phase pits, no pushback, so there's no big pre-strip. They're all essentially outcropping. And so very reasonable from a capital perspective on the mine side as well.
Okay, so famously high grade, starting with open pit, this is something that's been on a lot of investors' radars for a long time. And I know that readers have asked me, what about Sabina over the years I've had it? And before, the issue was always like, well, let's see about the permit. And that did take a long time, but you did get it. So now that permitting question is pretty much behind us. But that's been a while too, and we still haven't started building the mine. And so a lot of the questions that we have now, people understand, I think, roughly the deposit, and they see the merit there, but they're wondering about the company. And if this is as good as it looks, why haven't we built the mine yet? Or why don't we have mine financing? Or can you talk us through what you're doing now to advance the project and the rationale for what you're doing?
Well, from a permitting standpoint, we're less than 12 months having received our Type A water license, which allows us to start construction. And remember, this is a seasonal project. So we received it in November of 2018.
Okay.
That doesn't give you the time to organize everything for a sea lift in 19. And what we didn't have at that point is our entire logistics and supply chain worked out. We actually only completed that in May of this year, and that's a very critical component. Is we are the highest grade undeveloped pits of size in the world, but we're also a remote and infrastructure challenged mine. Now, not so different from a meadowbank of Agnico Eagles, which is about the same latitude, about the same distance from Tidewater, but they had a port. They had a landing area at Baker Lake. We had to build ours. We only built that in 2018. That still left 170 kilometers of winter ice road, of which we had a paper study that says, yes, we can do that. But from a financer standpoint, to say, okay, what's the risk on that? That alone would have probably added $30 to $40 million in cost overrun facility because of the uncertainty. And the reality is, if we don't complete a sea lift successfully, that can cost us $150 million when we're in the build, because it delays it a year. You look at all your construction and indirects. And so when we built it, again, between December, we started December 15th of 18, and the last load we hauled was May 12th of 19. Had we had 600 loads to haul on that first year, we would have failed. Now, the reason is we, because of the sea lift and barging in, we only had heavy equipment on one end. We had to build the road from one end. Now we have heavy equipment stationed on both, with now a portable sleigh camp that can go in the center, and we can actually work on 4 headings. We understand the route alignment. We understand some of the changes. We've had to make some minor route alignments. So these kind of de-risking activities are the ones that you really have to understand in order to move the project forward. So the second part of your question is equity and debt.
Right.
Well, part of it is we've actually been in discussions and have selected a debt provider and have better than indicative term sheets. But the hard part in this market is certainly equity. If we look at 2019 thus far, and the estimates, PDA just came out with an estimate from the mining perspective of, what will be total financing in 2019. 2018 was a bad year. 2019 is going to be half. The largest equity deal done this year was $150 million, and it was on a producing asset that was fixing some balance sheet problems, and it wasn't easy. So for us to move forward, the rationale and what we talk about at the board level is risk reward. We're in a market today that taking the risk to build, even if you execute and deliver, there are very few examples that are actually showing that it's accretive to build it and you're being re-rated as you move down that value chain. That Lassonde curve, the big part of it, the down is after that. We're through most of the Lassonde curve. It's that permitting time. It's you're doing all your technical studies.
Boring engineering
without
phase.
doing it. One of the things that we've continued to do, and very successfully, is explore. I think some people say, well, the money that you've used for exploration would have been better spent on development. Well, if we look at 2018 and 2019 collectively, we spent $19 million in exploration, not inconsequential. If we look at 2018 and 2019 permitting and project development, we've spent $83 million. But here's the difference. When we discovered the Novoic discovery, in one press release, we added 16% or $76 million to our market capitalization. It's those kind of things that will help us raise the equity in an environment when the equity markets are open. The equity markets today are not open, and I believe, and our board believes, the risk is higher than the reward in today's environment.
Okay.
So
let's dial in this a little bit.
Sure.
I'm without getting in a big long conversation, I'm getting 2 pieces here.
Yeah.
One is on the debt front. You're saying it would have costed more, like there were potentially offers on the table, but it would have cost more in the contingency, the overrun. It would have cost more to finance without having first built the landings and shown that you can de-risk the project. So in a way, this is reducing the overall cost of capital for the project.
Correct.
By following the path you have. Okay. On the debt side. On the equity side, it's basically, why raise the money now at this share price when we could dilute our shareholders less at a higher share price or in a more supportive market. Is that the bottom line there?
Not exactly, because it's not all about share price.
Okay.
If we were in an environment that with people execute and deliver, we're seeing re-rating from the developer space, that's more important than equity price. Look, nobody wants to raise money at a low price. Everybody wants to do it at the highest price possible.
Sure.
But if we look at a mean valuation, and I'm not talking about the peaks or the troughs in markets, first world, sizable, scalable, high-grade economic projects have historically traded at 0.7 to 0.8 times net asset value. Today, the average of the basket, including us, is that kind of 0.45 to 0.5 times net asset value. And the reality is that doesn't mean you can raise money at 0.5 times net asset value, because by the time the market says there's a deal coming, by the time the investment bankers say, okay, well, it's down 6 on your last trade, you're going to be raising money at 0.4. Look, for every way that an explorer or developer can make mistakes on their exploration, on their mine plan, on their resources, on their reserves, on their capital estimation, on their execution, on their hiring and operations, you can also do the same to your capital structure.
Right. So
and if any of those you make mistakes, some of those you can fix. Once the capital structure is broken, it makes it very difficult to repair and remedy.
Understood. So there are people out there who were watching this, and I was one who was thinking that, okay, once we get the permit, things will get going. And then it just kind of seemed like permit came and we're still kind of fiddling with it. But what you're saying is not that you couldn't have put together a project finance package at that time, but that you as a board decided it was not the right time to do it. It was more advantageous for shareholders, for the mine, to wait and do it under better circumstances. Is that fair?
I think that's fair.
All right, because that's important. There's because if it was we couldn't do it, then the natural question would be, what's wrong with the project? Why can't you finance this project?
No. Again, we got to the point of the committed term sheet, and on what we felt were very good conditions. This will be the third debt facility that I've been involved with. I think that some boards get focused on coupon. I think the focus really should be on flexibility of debt, because nobody has ever been put in default because they're paying 2% more of an interest rate. But when all of a sudden you have a covenant package that might be 10 to 15 covenants rather than the normal ones, which are debt service coverage, loan to life, and reserve tail. Those are the only ones that really matter. But you have all these other ones that have the ability to trip you up and take that equity solution away. So it's again, as your capital structure, that can be make mistakes, and the method of project financing. So look, it is a project that is financeable, and I think even in a market like this. But what we believe we need is the right risk reward. So what we have been doing, if market expectations are here, and remember, our feasibility was done at $11.50 gold. If you look at the sensitivities within our feasibility study and our technical reports, at today's gold price and exchange rate, that project is about a 35.5% after-tax IRR, and almost a $1 billion net asset value. But I think the one thing the two things that we have talked about is, look, it's a district scale project. It's got size. It has the ability to grow. We've made 3 discoveries since our last resource update. And we've been very aggressive on that exploration. We've been doing, 1 hole every 100 meters, 2 to 3 holes every 100 meters. Enough that we've developed another 1.5 to 2 kilometers of strike or plunge on these deposits. So not a resource at this stage, but certainly enough evidence that I think that people that understand these kind of deposits would say, look, the probabilities are that they will connect. And that also helps for 2 things.
Sure. So let me jump on that, because
Sure.
that is something people have asked about. You
Yeah.
have had a fair amount of exploration success. Why isn't there a new resource? And yes, I know you've been doing big step outs and showing something's there, but could we get to an inferred at least?
Well, the problem is once you have
a
a feasibility, is an inferred doesn't help on the economics. You have to get it to measured and indicated. If it was a PEA, I'd understand. But again, we've been so aggressive on these step outs, it would be close to $30 million worth of infill drilling.
Just to get to inferred?
To get to indicated.
Oh, to get
to indicated. And is that good value today? No, I don't think that kind of expiration is, because again, we've got a 12-year mine life already without converting any of these additional ounces into measured and indicated. We've got other indicated on things like the Echo Pit, the underground under Llama, which wasn't large enough to justify the capital structure or the capital to go underground, but now with showing that's over a half kilometer deeper down plunge, now we start thinking about those as eventual additional portions of the mine. But the one area that we have been focusing on too is what we call the vault. And the vault is a deeper portion of the Umwelt underground. And we have shown a significantly higher grade area that we've been able to hit very consistently over the last 2 years. And what we're looking for is the opportunity to be able to develop a higher grade underground in parallel with the high grade open pits. So if you can, if you could develop a 14 gram reserve at Umwelt, and even mine it at a modest 500 tons a day. Again, this is guidance.
I get it. It's one thing to discover more of the same. It's another thing to discover something of an entirely different tenor.
And with a better tenor, something like that, if mined in addition to what we're mining from the pits, could have the potential to add another 60, 70, 80,000 ounces a year. And again, not guidance, it's not M&I, but again, this is a strategy.
You're waving your arms, we get it.
This is a strategy of what we're trying to prove, and we hope that we be able to deliver that. Because, front end higher grade means quicker payment, which means that mistakes that do happen in execution and delivery, that there's some cushion. And again, having been through this before, look, we have a team that has the ability to build this. We have a team that has the desire to build it. But we also have a team and an executive that has the desire to do what we believe is best for the equity holders and create the most value.
Let me jump in on that, because that is absolutely the next question. People, and I like the way you turn to look at the camera and address the audience, because we're talking to you. That is one of the questions. If this is as good as you say it is, why haven't you been taken over? And if you don't get taken over, can you really build it? So you've answered part of that. Yes, we can build it, and you are Bruce McLeod. But why haven't you been taken over?
Well, we've never had a for sale sign on the company. Is again, historically, companies like this have traded at 0.7 to 0.8 times NAV, and the market has offered 40+% premiums. If somebody comes to you, and by the way, when I talk our net asset value, I'm only talking about the 2.3 million of the 7.2 million ounces of global resource.
Right.
So just the feasibility, just what's in the economics.
Got it.
So attributing no value for the Hackett royalty, for a bunch of the other pieces. We've never traded at that valuation, and the market is not embracing 45% premiums. So, we've got a table, it's actually within our presentation that's on our website that shows all of the advanced development projects, advanced exploration projects, and it's a simple graph on X and Y is grade on one side, size on the other. And we are the third best within that table. Is the only two that are better than us.
We'll put a link up.
Is okay, that'd be great. The only two that show better on that are one is in Colombia, one's in Ecuador, and both of them have major partners over 20%. And they're going to come off that table very soon because they're 6 months to 12 months out from producing. This table used to have Caminex, it used to have Del Radians, it used to have Probes and Integras, and we're left out there alone. Well, the reason that there is no for sale sign on this is a special asset. If we look at Meadowbank's production, open pit in Nunavut, last couple of years, 3 gram open pits were 6 gram open pits. If we look at logistics and infrastructure, the Lupin mine operated very successfully for years. It had a 600 kilometer ice road from Yellowknife to the Lupin mine. And by the way, Yellowknife, nothing originates in Yellowknife. Everything has to be trucked in. Well, we our sea routes, everything comes in from Bécancour, Quebec. Again, from a logistic perspective, better than many of those, and that's been proven. So if we're going to sell this, we have to do it it's in an environment that I think will recognize the how special an asset like this is. The reason it hasn't been sold is there's never been a process run on it. And at the right time, where there's an option between building and selling, we'll look at both of those. As a board, from a corporate governance perspective, we have to. We also have to have an upside case, at least internal, that says, look, from this other exploration that we've done, what is the likelihood of scaling up the throughput of longer life? Maybe at George, we've got 2 million ounces, a second mine within our same district. So you've got to weigh not only the upside, but you have to look at it from a risk adjusted model, because look, building and executing applies risks. So you can't take 100% of that value. You have to say, look, there's nothing's going to work out perfectly. But I think with good planning, with a team that has worked in the Arctic and executed a number of even far more difficult logistics projects than this, we've got the backbone for the right team. We've done a tremendous amount of engineering and design post the feasibility. We're now level 3 engineered through all of our WS, our work breakdown system structures. We're ready, and we're ready when the equity markets are open and ready.
Okay, so if a big part of the story is when the markets are ready, why should anybody buy your stock now?
Well, look, I think at the end of the day is one, we will continue, and again, modestly on exploration to keep showing that there is additional upside. And again, focusing rather on how much we're focusing on the ones that we believe can really change the dynamics and the scope of the project. We're also working on our last de-risking exercise, which is the third thing that I think a lot of people say about Sabina. It's less a Sabina issue. It's a mining issue. Is the stat is 30% of mining projects are 50% or more over budget. Now, with your logistics and infrastructure challenges, how can you guarantee that's not going to be the case?
Right.
Well, guarantees are hard to give, but what we can do is give more certainty. And one of the things that we're actually late on coming out with from our initial guidance is converting from an EPCM or a time and materials, a cost plus delivery of the plant and the mine to an EPC or a fixed price bid. Now, those fixed price bids is they were the first one from a junior was really Stephen Dean at Atlantic Gold. Yep. Did a tremendous job in delivering a project on time and on budget, and it worked out for many people. Now, Nevada Copper is using Sedgman, which is the people that we are working with in moving that project forward. And so what we've done is we did an engineering and design competition amongst the engineering companies. Sedgman won it. Mm-hmm. The weakness was Sedgman did not have Arctic experience. Mm. So they teamed up with Clark Gisborne Tarpon, which are a mechanical, electrical, and general contractor, which, by the way, built the Minto mine for me, which was a north of 60, 40 below in the winter. That was almost the same size. It was 2,750 tons a day. We built that for $115 million, not the capital cost.
By the way, long-time readers will remember that. We made money on Sherwood Copper.
And so what we're doing there is converting much of our project to EPC or fixed price bid. Now, an EPC is simply an insurance policy. Instead of me taking the risk on that, we're offloading some of those risks to the constructor. And insurance policies that you can actually cash aren't free. It will cost more to do that. The other thing it comes with is a performance guarantee. So the plant will operate to specification. There has been projects where that hasn't happened, and it certainly caused the equity holders the equity holders grief. Again, that costs money because in essence, the best way to guarantee throughput is to make sure that the plant you're building is a little bit bigger, which I think has the potential for some of those higher grade areas that we've talked about to provide maybe some additional throughput. And look, our capital cost, we have been guiding, it'll be closer to analyst consensus pricing. And the reason it's taken us longer is if we look at the battery limits between what the EPC provider is providing and the rest of it on the self-delivery is, the overheads across the project, the indirects were never broken out in those segments. Mm-hmm. So really what's it done is given us the opportunity to go back and recalculate. And knowing what we know today, which is 4 years later, and being on the ground and doing a significant amount of civil works, is put some costs that we think are more realistic. And the other thing that I think we've learned over the last 4 or 5 years is some of the things that we said, look, we can probably defer this capital and put it into sustaining capital, we've had a second thought in some of that. So there's going to be some scope change. But what it is, we're going to come up with an estimate that rather than an engineering company who has no liability and say, yeah, he can build it for this, or someone can build for this, we're now going to have a piece of paper for a large part of it that says, we will build it for this. And that is going to be a big catalyst and different method of delivery. So, I believe that's one that, and again, we're very close to delivery on that. I think that, albeit at a higher cost, at a much higher confidence of buildability within that time frame.
Risk versus reward. I have no problem with that, and especially after Atlantic showed how well that can work out. I'm all ears on that. So Bruce, what are the deliverables that shareholders or potential shareholders could look forward to over the next quarter or two?
The first is the delivery of the EPC, the fixed price bid. I think, again, that is going to give everybody more certainty in terms of our capital, less risk, and also that will come with a project execution plan on how we intend to build it in the time frame. And again, that's a level 3 study, so far down the path from a feasibility in terms of more advancement. Additional exploration, and again, it'll be modest. It's only about $4 million of exploration, which will be focusing on that high-grade vault zone, but this new 10-degree offset structure that we believe carries those higher grades, and will actually attempt to bring those higher grades from the vault zone up into the pit area, so about 450 meters of plunge. And I think that certainly will provide an opportunity for us to show that how can we deliver higher grades earlier in the project, and again, faster payback, more gold production potential means lower cost of capital and less risk.
You're being very responsible here and keeping the arm waving to a minimum, but as I understand from what you said, you have this higher grade vault zone, and you have found the same structure in some of the drilling that's been done closer to the surface, and now you need to see if you can follow up on that. But what's the potential there if those dots connect?
Well, look, we do see along this short limb, with this other dike and a little bit of pulling and stretching, so good tension zone within it, which is a good plumbing system for gold. If we can show the kind of grades and widths that we've seen in the vault where we've hit it, it's not uncommon that in close proximity to that dike that we've seen 300 and 400 gram meter intercepts.
All right.
Those are very special. So there could be an upgrading all the way to surface. Again, that is it's potential. We know it's there in the vault. We have to do some infill at some point.
But even if it wasn't continuous, if some of that's going to be in the pit anyway, then it's just a sweetener.
Yes.
All right, well, we'll leave it at that without too much arm waving.
Sure.
The one question I always like to ask everybody is the skin in the game question. Did you load up on a bunch of free options they gave you when you joined the board, or how much of your own hard-earned cash have you put into this?
Look, the company needed to make an executive change. I was recruited by several of the directors, of which Tony Walsh and I worked together through Miramar. Actually, Sherwood Copper, which ended up being a wonderful project, was an offshoot of Miramar. David Fennell, we did Palmarejo together. That project we sold for over $1.2 billion to Coeur. And John Goodman is someone I highly respect and convinced me to come. It was there were no founder shares available. This was an established company. I was given an initial option package, and so everything that I've acquired by purchase in the market and participating in each one of the financings that we've done. So I'm getting close to 1 million shares now that I purchased. That number will continue to go up as we move forward, and I think my plan is by mid next year that number will probably be double where it is today.
So you've bought on the open market as well as in financings?
Yes.
And you participated in every financing?
I think every financing, yeah.
And you haven't sold a share?
Never.
Okay, well, can't ask for more than that. Thank you very much.
Thank you.